Welcome to the Managed Funds Association live stream discussion on the future of short selling and its role in financial markets. I'm Michael Pedroni, Head of Global Markets and Research at MFA. I'm very pleased to be joined today by economist Jonas Bjarke Jensen of Copenhagen Economics, and very shortly by veteran short seller Jim Chanos of Kinekos Associates. Today's session is being live streamed and recorded. We're timing today's event to coincide with the publication of a major research paper by Copenhagen Economics on disclosure requirements for short sale positions. MFA commissioned this research because recent market events have led policymakers and regulators to ask the question, what kind of disclosure framework for short selling works best to protect investors and create the right incentives for short sellers? It's widely accepted that short sellers not only add liquidity to markets, but also help to detect overvalued assets, really serving to avoid market bubbles and ferret out corporate fraud. So without further delay, I'd like to introduce Jonas Jensen, one of the principal authors of the research paper on short sale disclosure rules, and we'll have a brief discussion. Jonas, welcome.
Thank you very much, Michael.
Jonas, you observe in the paper that Copenhagen Economics published just today that short selling improves financial markets and helps to detect corporate fraud, as in the cases, for example, of Wirecard and Enron. You also observe that short sale disclosure rules are different in the US and in Europe. In the US, we report aggregate short interest, but not an individual firm's short position. In the EU and UK, they require individual investors to publicly disclose short positions. What is the impact of the EU's individual public disclosure requirement on short sellers?
So I think the starting point for our study is that market participants, of course, are very careful about which signals they send to the market, which information they bring to the market. So the starting point is that this kind of disclosure requirements, as you described, it will change behavior of market participant. That's basically what we've been analyzing the study. Which kind of behavior changes do we actually see? And one of the changes that we see is empirically, we see that the short sell disclosure requirement, it discourages short selling. So we see less short selling because of the requirement. So ESMA has done quite a convincing study where they sort of follow individual investors when they do short selling. They see typically they come in with a quite sort of a low position. Then you can see how they increase their position, their short position. But then they find that typically they increase it just below the threshold, the disclosure threshold. Then typically investors don't want to increase more. So there we can really see that they are quite reluctant to cross this threshold, and therefore we will have we find that there is less short selling because of the disclosure requirement. And then, as you mentioned, it's sort of quite widely accepted that short selling is beneficial for price discovery. So when you discourage short selling, you have less short positions being taken. That impairs price discovery.
Got it. Okay, so the way in which the disclosure threshold functions in Europe, it actually, because once you exceed a certain amount of a short position in a stock, that individual investor has to make a decision. Do they want to surpass that threshold and then disclose it? And you mentioned, I heard you say ESMA. ESMA, just for our audience, is the European Securities and Markets Authority. So, you know, one of the things, Jonas, that we were really impressed with in this paper is that you formulated a new economic model to show that Europe's individual public disclosure threshold, this reporting requirement, drives what we call herding behavior. Can you explain what that means and what you discovered in your research?
Yes. So again, we're coming back to which kind of sort of behavior changing because of this disclosure requirement. And some of the other aspects we looked at was exactly herding behavior. So of course, when market participants, they price assets, they take in all available information. And one of this information is, have other investors shorted that given asset? And we know also from interviews that that's a very important piece of information. So that could lead one to believe that the disclosure requirement might lead to sort of copycat investing. So a given investor short a given asset, not because that investor itself have any sort of reason to believe it's sort of overvalued, but because that the investors see that there's another investor which they trust have shorted the asset, and they sort of believe that they had a good analysis and they just want to copy that position. So that is sort of the hypothesis that it could lead to this sort of copycat investing. And empirically, when we look at it, we do actually see that there is indication of herding behavior. So basically, we see whenever there is a public disclosure of a short position, it increases the likelihood that in the following days we'll see another public disclosure. We find sort of a 12% increase in the likelihood. That could, of course, just be because there are a bunch of investors that sort of act to the same news, to the same fundamentals. But we do adjust for that with using various economic techniques, and we do find it is actually the disclosure in itself that leads to other disclosures, and not because they just act to the same piece of information, because we control for that in our study.
Okay, and that's the new piece of evidence here, right? You not only do you see that the disclosure threshold is associated with more short selling, this copycat behavior as you describe it, but you actually run some econometric models to show that it's a significant cause of that behavior. So in some ways, with the US right now, what we're doing is we're looking at what the European disclosure framework leads to, and it leads to actually causes some of this herding behavior. So I can understand if I'm a manager, say of a large company in Europe, and one investor shorts my stock, and then that investor is forced to disclose it. I, as the leader of this large company, have to worry that others are going to jump on the bandwagon and short my company even more. So that's a clear disadvantage. But looking at it from the perspective of a policymaker, why do I care that a mandate for disclosing individual short positions drives herding behavior?
Yeah, that's a good question, because of course in itself, regulators wouldn't care so much about that some investors have their position being copied. The problem is that in general that it's quite sort of acknowledged that herding behavior and herding in financial market, it leads to increased volatility in the market. So it leads to less efficient prices, basically. So that's sort of in general why regulators tend to design regulation to avoid herding in the market. In this case, we actually also do find that a disclosure, a public disclosure, that leads to an increase in volatility. So we actually do find a sort of that direct link from a disclosure to higher volatility. And we see, it seems that it's due to sort of an exaggerated downward adjustment when there is a disclosure, because we also see sort of more lower returns than otherwise would have been for a given stock when there is a disclosure there. So it seems that there is sort of an exaggerated downward adjustment when there is a disclosure, and that leads to this higher volatility that we observe.
Got it. So that disclosure requirement not only hurts the company in a sense, but it also hurts all investors through this volatility channel. As you get higher volatility, that's not going to affect just the investor and the company. It's going to affect your kind of retail investors as well. Well, Jonas, thank you for the great collaboration on this, for your insights today, and for your efforts in adding to the body of research showing that even when controlling for other factors, requiring individual investors to publicly disclose short positions is damaging and counterproductive to maintaining deep and liquid capital markets.